We all need to make smart decisions with our money. The Long-Term Investor Podcast shows you how by distilling complex financial matters into easily digestible lessons. And now, here's your host, Chief Investment Officer at PlanCorp and the author of Making Money Simple, Peter Lazaroff.
Welcome to The Long-Term Investor. Today's episode is on the shorter side because I wanted everyone to stay tuned for a special book giveaway announcement at the end of the episode. But first, I'm going to give you 4 reasons you should be worried about the recent market volatility. Last week, the S&P 500 was down nearly 10% from its highs. People usually use the term correction to define a 10% drawdown. And that's usually the point I send out a communication that emphasizes the importance of staying the course and not worrying about the volatility. Now, I know I said I'm going to be giving you 4 reasons you should be worried, and I promise I will. But first, it's important to recognize these types of drawdowns are incredibly normal. Ben Carlson had a nice blog post that I'll link to in the show notes that provides data on how often we should expect a stock market correction. There's a table that goes back to 1928 and shows that the stock market loses 5% or more in 95% of years, 10% or more in 63% of years, and 20% or more in 26% of years. And I'll be sure to put that table in the show notes. Now, as Ben points out in his blog, these averages are a bit skewed by all the crashes of the 1930s. So he then goes on to look at data since 1950, and here's what he finds. The average drawdown was 13.6% over the course of a calendar year. And over the entire 72-year period, there have been 36 double-digit corrections of 10% or more, 10 bear markets of 20% or more, and 6 crashes, which he defines as 30% loss or more. But even though these types of drawdowns are completely normal, you might be feeling a bit uneasy. And you know what? Some people should be more concerned than others, especially if any of the following 4 things are true. Number 1, you went to cash. Even if you could accurately predict the future, knowing how the market will react is impossible. Going to cash requires you get it right twice. Once when you sell stocks, and once when you buy back in, making an already tall task insurmountable. Plus, the best days for the stock market historically follow the worst days. Missing out on those returns from the best days basically locks in permanent underperformance versus the overall market. There's a chart from my blog post last week that I'll be sure to drop into the show notes that shows the financial impact of missing the best days in the market. For example, it looks at the period from 1990 to 2020, and if you had been invested in the S&P 500 the entire time, your annualized return was 10.23%. But if you missed the best one day, your return dropped to 9.84%. Or if you missed the best 5 single days, your return dropped to 8.6%. Missing the best 15 single days resulted in a return of only 6.52%. And missing the best 25 single days brought your return all the way down to 4.88%. So the takeaway here is that if you've already gone to cash for some reason, then there's definitely cause for concern. Number 2, you own concentrated individual stock positions. Where we lack certainty, we can turn to probability, and the probabilities suggest that individual stocks are much riskier than you might realize. Looking at historical rolling annual returns, Vanguard found that individual stocks trail the median S&P 500 return 75% of the time. Even worse, JP Morgan found that 40% of companies that were ever in the Russell 3000 experienced a permanent 70% decline in price from their peak levels. But even if you were to ignore those probabilities and gamble on an individual stock or two, how would it change your life if you happened to pick a massive winner? Would you retire earlier, buy a yacht? My guess, it wouldn't change anything. The only way it could change your lifestyle, currently or in the future, is if you bet an outsized portion of your net worth on individual securities or in a specific sector ETF. And given the probabilities, I think you'd agree that betting a large percentage of your net worth in this manner is simply irresponsible. If you guess wrong and have a large amount of your wealth wiped out, can you really afford to start over from scratch? And remember, in this situation, you'd be doing so without the benefit of the longer time horizon you enjoyed when you first began investing. If I haven't convinced you on the dangers of owning individual stocks or even sector-specific ETFs, and you still want to try to hit a home run, knowing that it won't change your lifestyle if you're right, then I'd ask the most important question. What's the goal? If the goal is to provide yourself entertainment, I actually understand that and even sympathize with it. If your financial house is in rock solid shape, and I mean rock solid, then here's a suggestion. Put a small amount of money, I'd say no more than 1% of your net worth, into a separate taxable account from your primary investments. Then make your bets in that account. Go crazy, have fun, but leave your core long-term investments alone. We know the odds suggest that owning individual stocks will make you trail the overall market and even experience a permanent loss of capital. But you should also know that a good financial plan doesn't require you to hit home runs. It merely requires you earn a decent return that compounds its way into exponential wealth growth. Good investing is boring. If you're having more fun watching your portfolio than watching paint dry, you're probably doing it wrong. Number 3, your portfolio lacks diversification. U.S. large cap stocks, as measured by the S&P 500, have been the dominant asset class ever since the financial crisis. But non-U.S. stocks have historically performed better than U.S. stocks in down markets. Again, a blog post that I had from last week, I can link to it in the show notes, but I want to also highlight a table that I'll put in the show notes that shows the performance in months when U.S. markets are down. And it captures the period from 1970 through 2021. So there were 232 months where the U.S. stock market had negative returns. And in those months, the average return was negative 3.5%, which when you compare to international stocks, that return in those same months averaged being down only 2.3%. The fact that U.S. and non-U.S. stocks don't move in perfect tandem means that combining them can improve risk-adjusted returns, which in plain English means that you earn more return for the amount of volatility experienced. When it comes to diversification, you also really ought to have some bonds in your portfolio. You might scoff at the low yields on bonds today, but the purpose of bonds isn't income. Its role in a portfolio is to reduce volatility. And even though bonds are down year to date, they are providing that volatility reduction so far. Look, the key to successful investing is minimizing mistakes and not interrupting compound interest. Volatility doesn't interrupt compound interest, but it does dampen it. Volatility also makes investing more uncomfortable. Diversification helps reduce volatility and makes the investment experience more tolerable. But just as importantly, it also improves returns. Compound returns are higher when volatility is lower. So if you have two portfolios with the same average return and different levels of volatility, the portfolio with less volatility will have higher compounded returns. Seeing the math behind this is easier to do visually, so I'll drop a table from my book into the show notes that illustrates this phenomena. Remember, a truly diversified portfolio owns everything, which also means it always owns the worst performers. So you know you're well diversified if there's always a part of your portfolio that you are a bit underwhelmed with. So if you aren't diversified now, that would be a very good reason to be concerned about the current market volatility. Finally, number 4, you don't have a long-term financial plan. Market downturns are likely to continue occurring with a similar magnitude and frequency as they have in the past. Rather than trying to predict when or why they'll occur, it's far better to plan on them. Without a plan, you don't have any sense for how losses of any size are going to impact you, and any actions you might take will be purely reactionary. A recipe that historically results in bad outcomes. You hear me say this sort of thing all the time, but it's true. You can't make an informed decision about anything in your financial life without a plan. If none of the 4 things I've highlighted in this episode apply to you, then you really shouldn't worry about market volatility. Stay the course and focus on things you can control. Now, to my special announcement. My publisher accidentally sent me a box of my book, Making Money Simple. So I'm going to give away copies to the first 25 people that go to peterlazaroff.com/free book. Just select podcast on the drop-down menu, enter your information, and I'll personally drop a signed copy in the mail in the next week or 2. But before you rush to do this, please know that if you put an invalid email address or mailing address, the system won't process the request, so please take your time. And if you don't get the request in before the copies run out, then you can always purchase a copy on Amazon. Thanks again for listening, and until next time, to long-term investing.
Thanks for listening to the Long-Term Investor Podcast. To access free financial resources and submit questions to be answered on the show, visit thelongterminvestor.com. Peter Lazaroff is an employee of PlanCorp and BrightPlan. All opinions expressed by Peter and any podcast guests are solely their own opinions and do not reflect the opinions of PlanCorp or BrightPlan. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of PlanCorp and BrightPlan may maintain positions in the securities discussed in this podcast.